All right. Well, hey, good evening, everyone. It is 6 o'clock Mountain Time, so we'll get started. My name is Brian Cluthis. I'm with Fairway Independent Mortgage. I'm located in Colorado Springs. I've been in lending now for over 2 decades. I've held a variety of roles over those 20 some years. But my real passion is helping out first-time home buyers achieve the dream of home ownership. You'll probably hear me say this a couple times during the presentation, but buying a house is unlike any other transaction that you've been through before. Maybe you've gotten a credit card and had to fill out an application online with some basic information, or maybe you bought a car and had to bring in a pay stub or two. Home loan rather, is a little bit more expansive than that. We'll talk through that process this evening. We're also going to talk about credit a little bit, as well as what kind of loan programs are available, when to involve your realtor, and we'll even do an example of down payment assistance. So, with that in mind, we'll jump right into it. I mentioned I am with Fairway Independent Mortgage. Oops, sorry. Fairway has been in business for over 28 years. We are one of the largest national mortgage lenders in the U.S. As you can see from some of the stats here on the right-hand side of this slide, we have been a number two producer with USDA, which we'll talk about those products a little bit this evening. We are a large producer of VA loans. We're one of the largest VA lending companies in the US. And we've also been number one with FHA purchases, which is probably the most common loan product for non-veterans. So we'll definitely be talking about that product tonight as well. Buying a home, like I said, is different than anything else that you've probably done before as far as lending goes or getting a loan goes. So it can be a really exciting time. You're buying a house. But with that said, there's things going on that you don't do every day. It's not like you buy a house every other year, at least most of us don't. And it can be quite stressful. So our commitment to you is on multiple levels here. We try to be as transparent and accessible as possible so that if any questions come up, if any stressors come up, we're available to talk to you and to put your mind at ease and talk through the specifics of any kind of question or concern that might come up. Additionally, we are laser focused on making sure that your loan closes on time. You're going to have a great experience, but then if you don't close on time and you have movers in your driveway, it can turn into a very stressful situation. So for us, big thing is making sure that we are always on pace to close your loan on time, as stress-free as possible. So if you're joining the call tonight, you've probably thought a little bit about some of the benefits of home ownership, like why you would want to be a homeowner. And some of those reasons are really just on the surface, right? Like you'd like to be able to paint the walls or decorate the house how you want or remodel. Or maybe you're starting a family and now is the time that you'd like to get a house so that your kids have like their childhood home memories. And those are all great reasons to buy a home. But I want to talk to you a little bit about the financial reasons it could make sense to purchase a house. I just Googled the other day, wealth, renter versus homeowner to see what it came up with. And I figured homeowners probably did have more net wealth than renters in general, but I was surprised by the number. According to Google, homeowners have 40 times more net wealth than renters. You think, wow, how is that? Is it just that homeowners make that much more money in their paychecks than a renter does? And that's not the case. If you look at the left-hand side of this screen, you'll see that the reason for the gap Google cites is equity. So equity is the difference between what something is valued at versus what's owed on that property, on that asset. So in other words, the difference between what you owe versus what it's worth, that space there is equity or wealth. If you're on any of the sites where maybe you're looking at homes like a Redfin or a Zillow, that kind of thing, if you scroll further down on your screen, you're going to find the sale history of the house. On the right-hand side of the screen here, what I have is just a random house in Colorado Springs. And you can see that back in August of 2017, somebody purchased this house for $195,000. Now, 7 years have gone by. They probably don't owe $195,000 on the house anymore. Additionally, look how much they're selling the house for here back in November. They sold it for $425,000. The home has increased in value by $230,000 over that time. When they sell that house, they're going to be able to cash in their equity that they've earned by, if they sell it for 425 and owe 180, they're going to make several $100,000 just from owning a house. Now imagine that they continue to be renters and they continue to pay rent that entire 7 years. They would have earned no equity. I don't know about you, but personally, it's hard for me to put away $200,000 in a 7 year period of time without taking some kind of active or dramatic steps to make sure that happens. Great thing about a home is it's not only a roof over your head, but it's an investment, and why homeowners typically have 40 times the net wealth of a renter. So it's something to think about when you're buying a house. Um, you know, so if you're starting the process, one of the first questions you should be asking yourself is, how much house can I afford? Right. And the only way to tell that is to work with a loan professional. But the things that are factors that affect how much of a house you can afford are things like debt to income ratio. Debt to income ratio is a comparison of how much money do you have versus how much money do you spend every month. And that's how they come up with the ratio. The higher the ratio, the more stressed your budget and the less of a home that you can afford. Assets are another consideration, right? So there's things like down payment and closing costs that we'll talk about here in just a few moments. But you do need some assets in order to purchase a home. But when you think about assets, I want you to think about things beyond your checking and savings account. If you have a 401k, you probably have some money vested at this point that you could draw, or you could even just prove that you have in order to meet the reserves requirements of loans or to strengthen your file by showing that you have a bunch of this money saved up. Gift funds can also be used as assets. So if you have a family member who wants to help you with your home buying journey, help you take the steps to being a homeowner, they can with most programs. Debts are definitely something to consider. Credit is probably the biggest thing that people want to talk to me about that are first time home buyers. There's not a lot of education anymore in schools and such about how to build credit, how to manage your credit. However, there's some great tools out there and ways for you to unravel the mystery of credit. So let's spend a second talking about credit. What's in a credit score? Well, your credit can range anywhere from 800 down to 300, with the lower end of the scale being below a 600 credit score. When your score is at that level, it can be very difficult to find favorable financing or even financing at all. On the other end of the spectrum here, where you're up in the excellent, very good credit, you're going to qualify for multiple programs and you're going to have the best terms that are available. This does not mean you have to have outstanding credit in order to buy a home. So, how do you get good credit? This is a breakdown of what makes up your credit score. And you're going to see the number one thing making up over a third of the factor that's affecting your credit score is your payment history. If you have late payments, that's not a great thing. That's affecting your credit. And the best thing you can do is resolve your late payments and bring your accounts up to date so that you make those late payments a thing of the past, a thing of the distant past, ideally. Next thing that comes up here, making up a chunk of your credit score, is your amount owed. So if you're just establishing credit, maybe you've gone out and you've gotten yourself a credit card, maybe you've got $1,000 limit. You really want to limit how much you actually put on your credit card. And ideally, you have your balances represent only 30% of your maximum amount that you could owe or that you could borrow on your credit cards. So balance versus credit limit is what this section is about. And oftentimes, if you're working on your credit, this is one of the tools that we can work on together to get your credit cards down so that your credit score goes up and you qualify for more products. Length of credit history is a factor, right? If you're brand new to credit, that's obviously not as great as somebody that maybe has 7 years of on time payments reporting on their credit bureau. New credit, you want to be careful when you're having your credit pulled. Having excessive credit pulls in a short amount of time can have a negative effect and drive down your credit score. And then mix of credit usage is another factor. If you have all one type of credit, like I have two credit cards and that's the only thing reporting on my credit, that's not as great. is having those two credit cards, some installment debt like student loans, car loans, and a mixture of different credit products reporting on your credit report. Um, so, how do you maintain favorable, positive credit? The first thing is know your credit score. Right? So, www.annualcreditreport.com allows for a free credit report to you as a consumer every year, no charge. There's also some great tools online like Credit Karma and Experian where you can find out what your credit score is. There's multiple models of credit scores out there. So the one that those services use might not match up perfectly to what your mortgage credit scores are, but it's still a great starting point where you can learn what your credit score is and use some tools to help build your credit. Pay all your bills on time. And it's a really important thing. Having past due payments can really derail your credit score and make financing less favorable or not. Don't co-sign loans. Be careful with that. If you're co-signing for someone, keep in mind that you are equally responsible for that debt. So even if your cousin or whomever you co-sign that car loan for is supposed to pay it every month, if they skip a month, that's going to report as a late payment on your credit report. Don't close old revolving accounts. Sometimes when you're getting ready to buy a home, the idea is get rid of some of this other debt so I can afford a large housing payment and get my amount that I'm approved for higher, which is a great idea. However, you want to be careful not to close your credit cards after you pay them off if you're building your credit or you don't have a long credit history, because the closing of these accounts can actually negatively affect your credit score as well. And then be careful opening those new accounts, like we talked about, new trade lines, new credit pulls, excessive pulls. These are the kind of things that can temporarily bring down your score. And if you find fraud, let's say you do the annualcreditreport.com and you're seeing things on there that don't match up to your reality, then you definitely want to report the fraud, report it to the agencies, and get the credit matter resolved before buying a home. Um, you know, Mentioned before, buying a home loan is a little bit different than any other loan that you've probably done before. So I want to talk a little bit about the process to try to increase your comfort a little bit about how things flow. So the first step is an initial consultation. So during the consultation, you and I are going to get to know each other a little bit. I'm going to ask you things about how much money you have saved up. I'm going to want to know what your payment expectations are so that we can come back with realistic examples for you. As part of that initial consult, ideally, we get to the point where you're comfortable doing a credit application. So, on a credit application, we're going to collect information from you like your social security number, your date of birth, where you live, where you work, how much you make, what kind of assets you have, as well as your history of owning homes, maybe your history in the military service, things along these lines, so that we have a complete picture so we can figure out what products are going to work for you. The next thing that happens is I suggest working with a lender such as myself that offers soft credit pulls. So I mentioned on the previous slide, having too many credit pulls can actually have a temporary negative effect on your credit score. That's not what you want to have happen when you're looking to buy a house. So what a soft credit pull does is it's still going to return the three scores from the credit providers. However, it's not going to report as an inquiry. So it's not going to bring down your credit score. It's not even going to get reported to your credit. And you're not going to have to deal with a bazillion solicitation phone calls because you had your credit pulled. So it's a great tool. And then what we do is we can take the information from the credit bureau, mash it up with your application, and begin to find the best products for your purchase. The next step in the process is the pre-qualification. So at this point, we know what your credit looks like. We've got the application information, and at this point, we need to verify that information. So, unlike some of the other loans that are available, home loans are going to verify everything that you put on there. So, it's going to verify how long you've been at your job, what you do there, how much you make. You're going to need to send in a variety of different items. But once the information is verified, then at that point, you'll be issued a pre-qualification letter. This pre-qualification letter is a really important step because what that letter says is you're eligible for home financing up to X dollar amount. So when you're out looking at homes with your realtor, you're going to want to have a pre-qualification letter. Because if you find the one, right, that house that you love, you're going to want to make an offer on it. And you're going to want to know how much your monthly payment is. And you've already going to have all that hashed out. And this letter proves to the sellers that you actually are a bona fide shopper. You qualify to purchase this house. They're going to want to see this information from you when you make an offer on that house. So the next thing that happens is hopefully they accept your offer. And once your offer is accepted, if I can get my screen to go, here we go. I apologize. Let me back up one step. I wanted to give you some examples of information that's collected by your loan officer when you're going through the pre-qualification process, right? So it's going to be things like W-2s, pay stubs. We're going to know where you've worked for the last couple of years. You're going to want to have access to your checking, savings, 401k, investment account statements so that we can actually see what kind of assets are available. Sometimes federal tax returns are due or are needed, depending on the program that you're using. Also, going to want to know where you lived, if you were renting, if you owned, if you had no rent, all these kind of things as part of it. In addition, if you're a veteran, you're using a VA loan, the DD 214 form is really handy. And then we also pull a certificate of eligibility to verify the amount of entitlement that you have for your purchase. And then if you're self-employed, there's additional documents. Your income calculation is obviously a little bit trickier than maybe somebody that has a guaranteed salary annually, right? So we'll collect things like tax documents for the last couple of years to verify your business income. Moving on. So you're all pre-approved. You've made an offer on a house, and the sellers have accepted it, which is a really exciting time. So now at this point, we're going to send the loan to my processing team. My processor, she's smarter than I am. She's the hero behind the scenes, and she goes through everything to make sure that we have adequate information available. We've checked all the boxes that we need to in order to send the loan to the underwriter, which is the next step. Underwriting reviews all the information that's been submitted by you and make sure that you do fit the guidelines for whatever loan program that we're using. They also issue approvals throughout the process that list off a variety of different things that have to be completed in order to fully execute the loan. When we've satisfied all the conditions related to the loan, they issue a clear to close, which means you're all done and we're ready to get into the closing booth in order to make you a homeowner. Which, before we do that, is our pre-closing process. So throughout the mortgage process, you're going to receive multiple disclosures and written notices, especially if there's any kind of changes to payment or costs or things like that. There's multiple disclosures along the way that tell you about these changes so that you can talk them through and visualize these changes and get a good feel for how that affected your payment or how that affected how much you have to bring to the closing. So when you're clear to close, at that point, the title company and my closing team, they get together to make sure that they're coming up with the same numbers. And then once they agree upon the final numbers, a final closing disclosure will be issued. This closing disclosure gets sent to you before the closing so that you and I have time to talk through all the final numbers. Once that's done, it's just a matter of making an appointment at the title company and coming in and signing a few documents. This is a fun day, and I try to attend these as much as I possibly can. It's a great time. You sign a little bit of paperwork, and you get keys to your house and can begin moving in. So, the very final step in this is party at your house. So, like I said, it's a lot of fun. It is process. Your average closing, right? A closing from the time your contract is accepted to the time that you're getting these keys here can be anywhere as short as 2 weeks to 6 weeks. I would say on average, most closings happen 3 to 4 weeks after the acceptance of the contract. I keep mentioning it, but it is a different process than probably any other loan that you've gotten before. This slide kind of illustrates all the different steps involved, and you don't need to worry about most of these. The one I really want to point out is the very first step, which says get pre-qualified. So sometimes if you're sitting at home, maybe excited about buying a home, you might come across one online that you want to go see right away. This is the one. And great time to reach out to a realtor and start to make arrangements to do that. But let's say that you fall in love with this house and you don't qualify. There's something you needed to fix on your credit, or we're a distance away on the assets that we need to close. There's something that just has to get resolved before you can complete the purchase. You certainly don't want to fall in love with that house. So the first step here, get pre-qualified. Then you'll know exactly what you're working with. And then that's a great time to get with a realtor and start to see some homes in real life. Um, Next up is do's and don'ts. And we kind of talked about some of these already, so I'll make this slide quick, but make sure you can access your information. Again, how often do you pull up your 401k statement? It's probably not like a monthly thing that you do. It's just money that goes out of the paycheck and you're putting aside for your future. You don't pull a statement. It's not the kind of thing that you're going to access normally. So make sure you have a way to do that. Talk to your employer. And make sure you know how to get your pay stubs. A lot of times nowadays, right? It's all electronic deposit. You want to be able to access your documents. Notify your loan officer if you're going to use gift funds. Gift funds are awesome, right? Money from family to help you complete your purchase, money from your employer. If you're moving cross country to fulfill a position, sometimes there's packages involved to help you become a homeowner in your new location. Um, Notify your loan officer so that we can get proper documentation in line to have a successful sale or purchase, rather. And then notify your loan officers anything major changes in your life, any kind of major pay purchase, which you shouldn't be doing. Any kind of job change, obviously, you want to avoid that when the mortgage process is happening, but life happens. So if that happens, just make sure your mortgage loan officer is in the know so that they can adjust appropriately and advise you. Don't open any new assets, right? So they say buy the house, then the furniture, not the other way around. Don't open that Kohl's card, even if you're getting a 15% discount with your Kohl's cash. Not while you're buying a house. The priority is got to be the house. Any new trade lines that you open during the home buying process can be a major issue. What if this new trade line has a monthly payment? How does that affect your debt to income? What if this new trade line affected your credit score? We were working off a soft credit pull. Now, when we go to do the hard pull, your credits drop by 20 points. Do you still qualify for the same rate? Do you still qualify for the same program? Do you still qualify? Right. So be very careful once you're getting serious about buying home. Be very careful with what's going on with your credit. So let's talk a little bit real quick here about some loan programs that are available. This is a real quick breakdown of major loan programs, right? There's conventional loans. Conventional mortgages are not government-backed loans. Jumbo mortgages are just like what they sound like. They're for jumbo purchases. If you're buying a $1 million property, most likely it's going to be a jumbo loan product that's going to help you. FHA, which is the Federal Housing Administration, offers fantastic low down payment loans. It's a very popular product for many first time home buyers. USDA is excellent if you're planning on living in the country. USDA is specifically for rural areas. And then VA loans, which is specifically for active military, retired veterans, and surviving spouses. So let's talk a little bit about these programs, just a little more detail. Conventional loans. So conventional loans, when we think about that credit spectrum that we looked at earlier, talking about yellow to green, you have to have pretty good credit in order to qualify for a conventional loan. There's some awesome conventional loan programs out there. One of the programs allows for a 3% down payment for first-time homebuyers. That's a really nice low down payment to have to worry about. Another nice thing about conventional loans, if your credit is high enough, you could use their private mortgage insurance, which is cheaper than FHA required mortgage insurance. So there definitely are advantages to conventional loans, and you can pair this product with down payment assistance as well. Next up is FHA. It's probably either my number one or number two most used loan product. And it's very popular because of the loaned out payment option. You can have the FHA goes down to a 3.5% down payment. So you don't have to come up with a huge down payment in order to use this product. Additionally, FHA rates are competitive. And maybe most importantly, FHA services a wide spectrum of credit. You can have a credit score as low as 550 and use an FHA product. Ideally, you have a score of 580 or better to use an FHA product. You can pair FHA products with down payment assistance, like Colorado Housing's CHAFA program, and essentially have a 0% down payment. So again, wide spectrum of credit, um, and their debt to income ratios are forgiving as well. Your budget doesn't have to be as in great a shape as it does with many conventional products. Next up is VA loans. VA loans. If you are a veteran, you should be using a VA loan to purchase a house. 99 out of 100 times, this is going to be the best loan product for you. VA products have very competitive interest rates, and probably most importantly, they allow for a 0% down payment. So you do not have to pay anything for a down payment if you're a veteran, active military, or surviving spouse. Great product. And you can learn more about all these products by visiting with a loan officer such as myself, who will walk through the qualifications for each product and whether your profile matches with the product. So how do you figure out what's right for you, right? Um, there's guidelines on all these products, but nobody expects you to read those. That's hundreds of pages of reading, which is why you want to work with a licensed mortgage professional. What I do for my clients is after the application is done and the soft credit bureau is done, we look at each loan type that's available. For instance, for civilian, we would look at an FHA loan, a conventional loan, an FHA loan with assistance, a conventional loan with assistance, and we put these side by side for you and then talk through each of the features of these products so that collectively we can figure out which product is going to be best for you. And throughout that process, or as part of that process, you get a breakdown from Fairway of potential closing costs, an estimate of what your payment's going to be, an estimate of how much money you have to bring to close. Again, transparency is a really big thing for me. So I want you to understand from the very beginning about potential costs. That way, there's no surprises down the line. Down payment assistance is something that's very popular, and it comes in all kinds of forms. There are national programs available. There's state programs available. You can you can use down payment assistance with a variety of different loan types. And the whole idea here is to reduce the out-of-pocket burden of buying a house. So some down payment assistance programs come in the form of grants. And what a grant is where you get money to help with your down payment or your closing costs, and the money is forgiven. Some programs like T-Shack out of Texas, they have a program where it's forgiven after 3 years. Colorado Housing has a program where it's available immediate or forgivable immediately. Freddie Mac, Fannie Mae, both have first-time home buyer programs that provide grants. And then as a lender, I do a fair amount of business in Houston, Texas. We have a community access program that can provide you up to $6,500 of grant funds to help reduce your out-of-pocket expense when buying a home. So there is assistance out there. So why don't you hear more about assistance? Honestly, lenders don't make a whole lot of money off assistance, which is why some lenders choose not to talk about assistance. Here at Fairway, Fairway was the number one lending partner for CHAFA or Colorado Housing in 2022 and in 2023. In 2024, somehow we weren't. We were in the top three, though, from the rankings that I saw CHAFA produce. So I do a lot of down payment assistance, and I want to show an example of how down payment assistance can help you. This is an example of a $350,000 purchase. So buying up and down the front range, depending on what market you're in, depending on what market you're in nationally, 350 is just a random figure that I chose. So how does this work? You're going to have to pay a down payment, right? So in this example, we're using an FHA loan. FHA requires a 3.5% down payment. 3.5% of 350,000 is $12,250. On top of your down payment is closing costs. So closing costs, think of this as everything else involved besides the down payment. So some examples are the origination costs, if the lender charges anything for originating the loan, like processing, underwriting, point fees, things like that. There's appraisal costs. Get an appraiser out there to figure out the value of the property to make sure that what you're buying is being bought at a fair price. There's title information that needs to be gathered, and that's done by a local title company. And when they do things like make sure there's no other liens on the property, make sure that there's clear ownership at the title of the property, right? That there's no breaks in the who's owned this house, so that after you buy the house, you don't have to worry about some kind of claim coming up. They also handle recording. They also handle your closing and notarizing. So there's some things involved for title. They're also going to record your mortgage at the county. You're also going to pay for your first year of homeowners insurance on the property. And in most situations, as a first time home buyer, you're going to have an escrow account, which is money that's set aside to pay property taxes and homeowners insurance. So, in other words, if you were buying a home right now, some of your closing costs would be to set up your escrow account so that when your property taxes and homeowners insurance come due in 2026, that there's enough money, excuse me, that there's enough money in escrow to pay those bills. Excuse me again. Okay. So if we took the down payment plus all the costs involved, you would be paying about $20,250 at closing in order to buy this house. I apologize. All right. So this example is what happens if you don't have $20,000 in order to buy a $350,000 house. For a lot of us, coming up with $20,000 all in one shot might wipe you out, or might be even beyond your reach right now. But you don't have to wait until you have $20,000 in order to buy this home. Down payment assistance through CHAPA. In this example, we're using the First Step program, which is for first-time home buyers. They're going to give you 4% of your first mortgage amount in the form of a second mortgage. That second mortgage is at 0% and it has no monthly payment. You're going to pay back that assistance when you refinance the house, or when you sell the house, or in the unlikely event that you're there for 30 years, never sell it, never refinance, then it comes due. Doesn't happen very often. So this assistance is going to equate to around $13,500. So the assistance is covering your down payment. So now essentially your down payment is zero. And it's even providing a little bit of money towards your closing costs. So as a result of using Colorado Housing in this example, you would go from owing a little over $20,000 at closing to under $7,000 to buy a house. So that's a big difference in how much money you're having to pay out of pocket in order to make yourself a homeowner. Really, that's kind of the end of my presentation. I really just wanted to have a really high level overview of different products and a little bit about the flow and process of obtaining a home loan. I offer free consultations. There's never a charge for pulling your soft credit report or an application charge or anything like that. If you're interested, my contact information is on the screen, available throughout the week into the evenings. You're welcome to call, text, email. My website is on there where you can see recent customer reviews. And then if you scan this QR code, it will actually take you directly into an application where you can fill in your information. And within 24 hours, I will respond to you with loan options or a credit plan. I appreciate your time this evening and joining me. I hope this was informative for you. If there are any questions, please reach out. And thank you again, and best of luck on your home buying journey. Thank you.